Hello, my name is Phil Blancato, and I'm from LTAM Asset Management. I hope your 2015 is off to a good start. Well, let's talk a little bit about the equity market, bond market, and international markets. 2014, the U.S. stock market had a wonderful year, up over 13% again, for two reasons pretty much. One, U.S. corporations continue to benefit from very low interest rates. And two, you, the consumer, are in better shape than any time in recent memory. 2.7 million new jobs created in 2013, wages up over 4% for the last quarter of the year, and believe it or not, a 5% GDP in the third quarter of last year. Add to that, gas prices rapidly falling, and the consumer and the U.S. economy is really in great shape. In fact, the United States has become the global driver of growth, considering the rest of the world is really kind of struggling. We expect much of the same for 2015. We think the U.S. stock market will continue on this same path. Low interest rates, coupled with a strong consumer, should lead the equity market higher to the tune of another 8 to 10%, because the bull market doesn't die of old age, it dies of a recession. We don't think there's one on the horizon anytime soon. International market's a little bit different. The European Union continues to struggle. China continues to slow down, predominantly because in Europe they have very high unemployment, very high levels of debt. So more than likely, the European Union will stimulate its economy by doing some sort of quantitative easing program, like the United States. We think that will greatly help their economy get going again. They're a large continent with lots of money and lots of people. They're going to need a kickstart, and it looks like they're ready to do that. If that happens, international stocks should perform better. Emerging markets like China struggle when the United States is the global driver of growth. You see, as the U.S. dollar goes up, emerging market currencies go down. They're also very commodity-centric, so when oil goes down, they're also hurt by that. So it'll be some time before emerging markets recover. Now, having said that, they're very young populations, and they have low levels of debt. So long-term, we're still very excited about the asset class and still own a portion of them. In a diversified portfolio, you want to not put all your eggs in one basket. But having said that, there'll be some time before they get the ship righted again, especially as China hasn't quite figured out what its right growth that is going forward. Alternative investments like oil. Very exciting what oil has done for you, the consumer, and for most U.S. companies. 300 million people have benefited by the correction in oil, lower gas, lower home heating. In fact, you're saving $1,800 a year now based on this correction. Very exciting to pay $1.50 a gallon in Oklahoma today. Very low prices. But for the people that are related to oil, the 10 million that are in the energy industry, it's been a tough time. They're making less money than they did in the recent history, and for that you're seeing a correction in bigger companies. We own MLPs in the portfolio, the transportation system for oil and gas. They really don't make money based on the price of oil, just on demand. Demand continues to be up in the United States, but yet MLPs are down because of this correction in oil. Doesn't really make a lot of sense. While long term we think MLPs will be just fine. But in the short term, lots of volatility in the energy sector. Long term we think it'll be great for you, the consumer. Great to own MLPs. Just right now, a little bumpy. The bond market. Bond market's been a tough and interesting place. Last year we thought the bond market was going to be down. We thought rates would finally rise and prices would go down. That didn't happen. Didn't happen because the rest of the globe has bonds that are very much underperforming. So the rest of the globe decided to buy United States bonds because they're safer and actually we're paying a little bit more. 2015 might be a little bit different. The Federal Reserve will probably raise the Fed funds rate. If they raise interest rates, then the bond market should go up with it. And if that happens, there could be lots of volatility in the bond market, maybe even some negative returns. So we're watching that closely. Might even be doing some rebalancing in that area of the portfolio because the bond market's going to be a little bumpier this year as the Federal Reserve raises rates as the U.S. economy gets more healthy. So in summary, as I mentioned earlier, we think the U.S. economy is doing great. Sort of an island all by itself out there as the rest of the world continues to struggle. We can be the global driver of growth, and we can be isolated because you, the consumer, are the major driver of our economy. So high expectations for the United States, less expectations for everybody else. By and large, diversification still works to lower your risk. We continue to believe in diversification, continue to have a diversified portfolio, with our emphasis being on the United States. We hope this was helpful for you. Please contact your financial advisor with any questions. We look forward to seeing you all real soon. Have a wonderful 2015. Take care. Thank you.